Hello everyone, it's me the Boss Hog. We're back after a pretty long time away. Sorry about that. I've had holidays, I've had work, and my sister was a bit poorly. Decided to give myself a little bit of mental space. But to be honest with you, mostly it's just been very busy at work and just haven't quite been in a good mental space. All that said, I'm sorry to have disappeared for a couple of months, and I thought, well, what are we going to do for my first video back? Let's do a portfolio update. Pretty much everything that's happened between March, when I last did my update, and today, as of the 19th of June. Let's do it. All right, so in terms of the current situation, actually a pretty interesting start to the year as we decided to move quite a lot of money from our mortgage offset account, so basically a savings account that reduces the amount of interest ultimately I pay on my mortgage payment. Decided to move 17,000 in one go to take advantage of an unexpected wobble in tech. Honestly, I don't even remember what really caused it, but probably Nvidia had a bad day, which meant the whole of the stock market had a bad day. But that in hindsight was a sensible move. Managed to buy of that, put 13k into Alliance Technology Trust at an average of 356. That's currently about the 400p level, so a pretty decent return fairly quickly on that as well. But as a result of that, my wife's ISA is fully maxed out already. Bearing in mind this is the tax year, so we have until next March to do it. And we've also got 4,000 in my personal ISA as well. So this is going really good. You can see there the trading 212 should reconcile with the screenshots from my brokerage in the table. And then Google Docs is my own reconciliation point. And again, there should be pretty tight reconciliation between those two, as we can see it here. Probably the figures to look at are the 14-week changes. So the trading 212 deposit has been 24,000 across that time, and then trading 212 itself is up 41 and a half. Google Docs the same, and then the delta there between those two is basically our profit and loss. Profit obviously over the last 3 months there, so up 18k in pure profit over that period. It's been a really great stock market. I'm slightly underperforming the S&P 500, as you'll see very shortly, but comfortably beating all my other measures. So feeling pretty good, honestly, and I'm really pleased with the moves that I made over the last couple of months. They feel pretty decisive, and as well as buying a significant amount of Alliance Technology Trust, I've also sort of been buying positions of political wobbles, I guess, for want of a better word. So I opened up, a French ETF. I added to my Indian position. I added to my Dutch position. So I'm just sort of trying to take advantage of any kind of wobbles because the rest of the market does look fairly expensive at the moment. So that was part of the rationale there. And I've also been changing my investment thesis and targets for this year as sort of the interest rates have defied expectations, I guess, and stayed big higher for longer. But broadly speaking, happy with the current situation. This is it so far. We're going to continue to try and add to my ISA and get that maxed out as soon as possible. So probably need another, I don't know, 4 to 5 months or so. And then we'll spend the end of the tax year, so until March next year, basically topping up our offset mortgage and adding to premium bonds and that kind of stuff as well. So for now, though, we're super happy. This is our most important financial target, and we're definitely running ahead of schedule, albeit having raided our savings account as a result. And by the way, I had a little bit more confidence raiding my savings account now that trading 212, my brokerage, allows you to deposit. I could deposit 20 grand and then withdraw that 20 grand in the same tax year. So essentially, at the moment, even though this is fully invested, so I shouldn't really be selling it, but I could do if I wanted to, right? I could sell this, take out 24,000, and not have it impact on my tax wrap or anything else. So that gave me enough confidence to basically do what I did, and rewarded by a relatively quick rebound in the things I was buying. So that felt pretty good. Anyway, this is just at a summary level. We're going to have a look at my full portfolio and exactly how it looks next. All right, so ordered by weighting. Now, in fairness, we remain very top heavy. So even though I've got 41 positions here, which is probably too many, when we look at our top 5, 10, and 20 positions, you can see here extremely top heavy. Just the two top positions, which are basically funds, so not single stocks, they're sort of over 40% between them. And then we've got Gamma and Amcor, my real conviction holdings for me. And then BlackRock as well, which is Throgmorton Trust, which is how I would describe this as a high quality UK focused fund within at small and mid caps. So for me, I sort of like this because I'm getting a discount against the NAV of the trust anyway. Plus, I believe that UK equities are sort of unfairly maligned and beaten up at the moment. I'm enjoying some of the best discounts that I've seen, and for me, I'm not minding too much whether I get a big fat dividend or whether they get taken out with 30 to 40% premium on the share price, or whether we just keep adding and enjoy it, put it away for the long term, and things like that. So I've definitely been focusing on my larger holdings over the last few months and putting as much money into them as possible. And yeah, really any kind of weakness I've sort of just seized on. So even within the alliance, I think it went down to about 345 at the lowest. I was just sort of continuously adding as much as I could. And I had like originally it was 350, and then I think it was Nvidia put out some numbers, and I'm like, this is 10% of this fund, still smashing it, and I just didn't really know what caused the wobble. So I was like, right, anything under 360 I'm going to buy, and then he just kept on sliding. So I was like, right, I'm going to have to put some more money into this. So for Allianz, I'm looking at like £3.50. For Scottish Mortgage, I'm looking at £8.50. And yeah, for Frogmorton, anything under 625. Those are my kind of big buys on my marquee positions. Well, with Gamma and Amcor, I can't buy outside of dividend reinvestment just because my wife works in private equity and has restricted trading. So our big buys and new capital go into those kind of positions. Outside of that, and as I've already touched on, yeah, I opened up a new position in French ETF there, got just under £1,000. We've also been adding back into our US banks position, so we've been swing trading that with some success, mixed success, let's say, but profitably. And so, now we're rebuilding our position in that as well. But broadly speaking, I'm happy with this. The one big change I think that I have been doing also whilst trying to manage these fluctuations is I've, broadly speaking, sold out of almost all of my REITs and emerging market positions. I think the REITs is very obvious as to why, just interest rates staying higher for longer, REITs are exposed, etc. I guess the emerging markets might be a little bit more eyebrow raising, and for me this is sort of a lot of my emerging markets position were more small caps anyway, and I think sort of that combined with political uncertainty and the fact that small caps are having to pay more to borrow money because of, again, high interest rates, just means to me that I'm sort of reappraising the risk and reward of these kind of holdings. And instead, although I'm quite happy still to buy sort of small and mid caps, I'm sort of looking at, the S&P 600 and the FTSE AIM, or these kind of positions, like also Fidelity special values, BlackRock, Frogmorton, that are focusing on sort of, let's say, more safe, but still an element of small and medium and long-term risk. So I will be still focusing on some of my emerging market positions, but definitely I've been sort of profit taking a little bit and generally, yeah, just reassessing. And I think as well as big tech, obviously getting a lot of the news because of Nvidia, really, as well as Microsoft and Apple. But also, like, these companies sit on massive cash piles. And again, like, if you're able to very easily get 5% and you don't have to borrow money to grow, you're basically entrenching your position all of the time, giving yourself options, potentially being able to buy distressed companies. I just think sort of the situation's pretty ripe for big companies and successful companies to become more successful. And worst case scenario, because I'm sort of investing in UK stocks and US small stocks, there's always an opportunity that company will come and buy them, and in general, if not, then that's okay as well. So slightly different focus to what I was originally expecting a couple of months ago, but that's the rationale that I have. I believe it's just my French position, which is entirely new. Everything else here is and actually, sorry, maybe my nuclear position as well, a couple above it. So sort of in the middle there, you'll see my uranium and nuclear tech. Maybe that's a new position as well. Sorry, it has been, I guess, 3 months since we had our last update. Again, I guess I should just explain that. Really, it's a case of, I think a lot of the renewable energy isn't quite ready to go. I think nuclear is starting to get a bit more love. I think nuclear in general is something we should be building toward anyway. And I thought this ETF, it's not exactly speculative. It's got a lot of sort of established players in there that are not just, mining or power generation, but a pretty interesting mix of companies exposed to either nuclear and or uranium. So that was my thinking there as well. If I'm honest, I don't think either France or nuke will ever be a massive part of my portfolio, but I'd be more than happy to take them to like 1, maybe 1 and a bit %. and really just treat them a little bit opportunistically, or just keep them for the long term. Again, either is pretty flexible at the moment. I would just say as well that partly with Allianz, but also with all of the ETFs I just mentioned, I really haven't been buying a ton of dividend stocks. And where I have, it really isn't like the dividend isn't my primary reason for buying. Like Frogmorton, yeah, that's got a decent yield. Things like Fidelity Special Values, also a solid yield. But on the whole, like I wouldn't really class myself as a dividend investor. So you'll see later in this video. But I've definitely been seeing my yield reduce over time, but I'm completely fine with that. I'm really focused on long-term growth of my portfolio. Whether that comes from dividend or capital doesn't matter too much. But again, everything I've just spoken about before in terms of tech and big tech remains part of the thesis, and so that's where most of the attention is going. And they just don't tend to pay a ton of dividends. And certainly Allianz being a good example, that doesn't pay any dividends at all. Scottish Mortgage does pay a dividend, but very small, at 0.6%, I believe, and those kind of things as well. So even though I'm not against dividends and that they can be super nice to receive, it's not really a reason for me to either buy or not buy a trust. And oftentimes when I'm given the choice of buying an ETF or an investment trust that has both an accumulation and a dividend option, the accumulation is actually cheaper because I guess people like the dividends, and so for me, I'm always more interested in buying the cheaper version, shall we say. So that's all my rationale and how my portfolio currently looks at the moment. And I'm pretty happy with it, honestly. So yeah, no major changes. Happy to answer any questions or etc. Please feel free below, and I'll do my best to answer them. All right, so I reduced the number of graphs on this slide from 5 to 3. I think these are the important ones, to be honest with you. So the top left there, it's kind of cool that the teal section is really starting to separate itself now. That's basically profit that's not related to dividends. Green is capital and pink is dividends. So pink can never go down, blue can go up and down, and green, I guess, could go down as well, especially if I withdrew a large amount. But broadly, I would expect it to move up in the same direction. So that's cool. Over time, I would definitely expect the blue and the green to grow as a percentage, especially when it gets to the stage long-term future where it has the potential to grow faster than I can deposit into my ISAs. So that's the expectation there, but we'll see. Then on the right is my profit over time. Had a big dip when a certain country got invaded by another country, as well as sort of COVID. So it's been, or maybe it was just after COVID. Some of the wobbles there are sort of repeats as well, especially in the middle where it's like, a different variant and things like that. So that's been interesting. However, for the last year, it's definitely been on an upward track. And now we are at all-time highs, pushing 50,000. So that's cool. It is maybe worth saying that the US and UK profit, this really is about the stock exchange locations of the assets that I hold. So as an example, Allianz Technology Trust, a lot of that is US listed companies, right? The big two are Nvidia and Microsoft in that fund. But that would be classed as a UK position because Allianz Technology Trust itself trades on the UK market, and therefore it's a UK position. So in fairness, this is like the details here with the blue and the green line, especially since I've only been buying ETFs because of my wife's position, has sort of changed the dynamics of this chart a little bit. But overall, the dark green line, the total, is valid regardless of how we break it down. So this is genuine profit. And I have to say, it is my favorite graph to look at. It feels really good, especially when you look back over time and sort of you can see it also gradually reducing. Like I remember that big dip sort of 2.5 years ago, and it felt really gross. And now it doesn't actually look that significant anymore. And I'm hoping again over time that will continue to be the case. And then the graph at the bottom, which I've made quite long, this is my most important graph and will be for the foreseeable future because this really measures how I'm performing against my benchmarks. So we still trail the S&P, who is on fire, helped by tech, although to be fair, I'm also helped by tech. But I'm really pleased with the performance, definitely keeping it up and trying to keep up. I've also slightly extended my lead over the MSI All World, which arguably for a UK investor is the more important benchmark, but again, it depends how you want to measure it. Then I'm comfortably smashing the FTSE 350, which continues to be sort of safe, but relatively uneventful. And then we've got the CPI and the bank as well. So CPI just an inflation measure, and the bank what I relatively generously think I could get in a bank account. You can see there as well, that's basically cash. So that's again good for me to see. And sometimes, like when I'm feeling a bit bad, maybe the market's had a poor day, I go to look at these and sort of realize that it was still the right thing to not leave it all in cash, even if that is, a little bit bumpy and that kind of stuff. So these are my graphs. I took out the sector segmentation, and I also just took out my overall portfolio value. So I didn't think the segment was adding that much to it. And the overall portfolio, you pretty much see the same graph in the top left there, just broken down by capital growth and dividends. So that's the thought there. If anyone is interested in seeing those graphs back, then feel free to say, and I'll make sure they're in the next video that I do. All right, so in terms of dividends, again, this is everything since March to date, effectively. So total dividends received were over 9,000 now, which just reminds me of the Dragon Ball meme. So yeah, I'm over 9,000. In terms of the dividend received March to June to date, we've got 678 plus another 220, give or take, remaining. A big part of that is my Gamma dividend, which is going to be about £160. And then sort of a few 20 odd pounds from various positions coming in the final week of June. So that's what constitutes that. If I compare it to last year, which in fairness does have a slight advantage because it includes all of June, the better part of 1,000. So this is an example where even though my portfolio is significantly bigger year on year, actually my dividends is less. And that's, again, just as a result of not buying individual dividend paying positions and not really focusing on dividend as part of my investment thesis. If I actually look at the specific causes of that reduction, I'm sold out of my Huntsman position. That at one stage was my largest holding and responsible for my best ever day's performance to this day. So that's great. DLR, so Digital Realty, I sold out of a little while ago for a modest profit, but again, it was a case of moving away from REITs, didn't really gel. Then Legal and General, I decided to sell this because even though it's a little bit cultish, it's a pretty safe company and everything else. I thought the trading update was quite poor. I was expecting it to be much better as they sort of moved past their housing prefab unit, and basically would have expected the investment returns to start improving by then. And when I saw the results, I decided to not even stick around for the dividend, just sold out and etc. So again, fine with that position as well. I just don't think I'm really a Legal and General investor at this point in my life. When I first started, I really liked the dividends. I really liked Legal and General. I thought it had a lot of potential to sort of be very benefit from cross-selling, investment returns, etc. But it just hasn't really performed in the way I wanted. My TRET here, this is my REIT position. So I already explained here, just sort of, I sold out most of this in January and February. Actually pretty well timed. I could have been a bit quicker by selling it all in January rather than February. But again, made some profit on this and was pleased to, at one stage it was about £10,000 in my portfolio. So sold this right down basically and took some modest profit. And then MPW, obviously Medical Properties Trust here. Yeah, I'm pretty far down at the moment, about 70% on my unrealized position, probably about 40% on everything. So once I take account of dividends and previous realized sales, but still pretty ugly. And obviously MPW reduced their dividends. So all of those things are having an impact in terms of reducing my dividend for this period. I would say Legal and General is the largest of that, as is my real estate REIT. Together that would be like £250 between those two, and then Huntsman and DLR, that's going to be another sort of about £70-80 between them, and then MPW probably another £40 as well. So that's roughly the makeup of those. So to be honest with you, I'm not totally convinced I'm going to meet my 2023 dividend target this year. It's going to be kind of interesting, just where I've been selling out of some of my dividend positions. I have also been buying other things. So yeah, things like Frogmorton, Fidelity maybe later in the year, but also things like Phoenix, for example, and other sort of very large positions I will still expect to get a dividend on later in the year. So I think it'll actually be pretty close. It would be nice to hit the 3,000 at least this year, just to continue that gradual uptick. And I'm also really looking forward to hitting my 10,000 in dividends received total for the year. So that should be good fun. All right, and last but not least, I've actually seen a couple of really good videos about averaging up recently, literally like the day after starting to piece together this video. So I would highlight actually Damien Talks Money. I thought his video was really good, as well as the ever good Joseph Carlson. But I also wanted to sort of give my own summary about the importance of averaging up and using data, which is very me, and specifically a couple of positions that I have. So first of all, I find it just as hard as everyone else to buy into a green market. It's not always the easiest thing to do. And I think it took me, I've been investing for about 3.5 years now. I would say it took me at least 2 years to kind of start feeling comfortable with the idea. Um, and part of that was sort of helped by doing this. So what this is it's sort of a summary by position by month. And what it allows me to do is sort of see my profit broken down by month. And so, if I look at Allianz, for example, in May, I mentioned I bought £13,000 worth of shares. You can see it there at the bottom for sort of 3,690 shares, and my average there was 356. And you look at that, and my overall average on my position I think is only about £3, something like that. I think before this buy it was actually under £3. But then it's like, well, hang on, I've just bought this, and I'm already up 11%. And like, if I'd have taken this to the extreme and just stuck with maybe the shares I bought in 2022, yeah, okay, my margin would be sort of well into the 80%, right? But my overall profit would only be about 2,300, which is still decent. But actually, I'd much rather have 11 grand's worth of profit, even if it means my margin is only 30%. And to me, like, I think this is it. Like, you've got to have confidence in and a willingness to keep buying, even if you're averaging up. So long as the shares, whether that's a single position or a fund or an ETF, as long as you think it represents value for money, I think it's perfectly fine to continue buy it and sort of just get over yourself. Like, there will be opportunities to buy this in the future for less, probably, because there's going to be at least one market crash between now and the time we retire, probably. And for me, it's sort of like this sort of data just reinforces how useful it is to average up, right? The other thing that's useful for me here is it also shows when I sell shares. And I think especially historically when I was buying and selling at will, I had this bad habit of selling shares and not holding on to positions as long as I could, potentially taking transaction hits. Again, I think it's a not uncommon novice thing to do. Now, in fairness, for Allianz here, my only real sell is the one that I've listed there, and that was sort of during a bit of an account tidy up on a relatively small part of my position. So yeah, I think that was the rationale there. But even still, like, I look at that and I'm like, oh damn, what did I actually buy with that money? Because if I'd have just held on to those shares, it would be worth £400, right? That's what that negative profit actually represents. It's like my opportunity cost. I didn't make a loss when I sold those shares, right? I sold them for 229, and my average at the time would have been something like 210. So I still made money on them, but the thing is if I'd have just held these today, I would have made another £400, right? This is my opportunity cost as a result of selling. So sort of for me, this is useful and sort of humbling and reminds me of where I'm at. And I do find it very useful, especially when I'm averaging up. Like sometimes I'll look at this data and I'll be like, no, it's still correct to average up. Now, in fairness, I probably wouldn't buy Allianz Technology Trust at the kind of levels it's at. But saying that, I would also be seriously looking at sort of what my new buy price might be, what kind of companies I want to do well, or in order to sort of justify increasing my price. The general thesis of big tech, in semiconductors. Like, one of the interesting things over the last couple of months is Allianz Technology Trust has moved further into semiconductors. 5 of its top 10 positions are semiconductors. Nvidia is its largest holding. And it remains basically all US tech, big tech. Whereas Scottish Mortgage Investment Trust, my second largest position, has kind of had a bit of a pivot away from the West and has been increasing its Chinese positions, adding its South American positions, and so hasn't actually benefited as much as Allianz has because those areas have been underperforming relatively. It also does a lot of sort of consumer discretionary, which I'm quite bullish on. That's part of my reason for buying SMT. But actually, again, that hasn't been a particularly loved sector. So it's sort of like interesting to me to where I have these two marquee positions making up 40% of my portfolio, that even though on the surface everyone's like, oh yeah, those are two big tech funds, actually I view them as quite different things. And the other difference with SMT is that they have a private, 25 to 30% private companies, and Allianz don't. They used to, and then an investor basically changed the way they approached it. And that same investor now, Elliot, is trying to change the way that the SMT work, and I don't want them to. But yeah, for me, like, my two marquee positions are really only surface level the same thing. They're quite different, and so that partly explains why they're performing differently. But again, I'm quite bullish on both of them. So I think my lesson here is essentially, as long as you believe in the price, it shouldn't really matter what price you've paid previously, and what your what your hopes are for being able to pay for it in the future. It should be a case of, am I willing to pay that price today? If yes, then you should just keep buying, because in the long term, most stocks go up, and I think this is even an easier decision for broad-based ETFs and investment trusts as well. So just my personal opinion on it. And then similar as well for BlackRock. So here there is a bit more selling, although in my slight defense, I did move this between ISAs, which is the main reason for the November sell there. And in May, I was also taking advantage of sort of some, again, wobbles in the semiconductor ETF, as well as sort of actually buying some broad-based positions, sort of emerging markets, IDP6 for my S&P 600. However, I then realized that even though I sold at 631, which it wasn't exactly an amazing price, but I was fine with it, that maybe I was sort of regretting it, and the share price also went down sort of 4%. So I decided to get back in again, and actually ended up increasing. So you can sort of see, like in May, I sold a net 800 shares at 1100 sells at 631, 300 buys at 604 average. And then sort of in June, I was like, oh, maybe I want to rebuy these again. So I then sort of added 1250 at 614. So here, eating out a couple of percent profit for sure between these two things. And yeah, just sort of, again, rebuilding my position. BlackRock is sort of my joint third to fifth largest. They're all about 20 grand each. And we still like this at 617, which is what it was when I did this snapshot. I will be looking to add to this position, saying that both of these shares sit in my wife's ISA, which is now fully maxed out. So I'd had to sell something and move some money around in order to add to this. But I will definitely be looking to add, given any kind of real opportunity to do so. So yeah, I just wanted to share these two. I have one of these for every single one of my holdings. So if anyone's interested in one of my other companies from my breakdown, feel free to ask, and I'll do something very similar for this. Happy to do it for any company. There's no, I just picked these two because they're large positions and they sort of illustrate the benefit of averaging in over time and those kind of things. So thought I would share. Anyway, this is a video I think is long enough. Thank you very much for watching, everyone. I will do another one of these videos at the end of July, let's say, and within that then I'll also finish off June, and we'll basically do a June and July and then try and get back into the monthly cycle again. So that will be the plan. In the meantime, I will start to also update videos on sort of the wealth position, on the budget position, and anything else I can think of as well as potentially doing a deep dive. Like, I'd love to do a deep dive on SMT at the moment, just because quite a lot of stuff is happening with that. But there's also updates from like Redrow being purchased. The Games Workshop just released their results. Gamma released their results as well, very solid. We've got Amcor coming up as well. Hollywood Bowl, I thought results were solid as well, though the market didn't like them as much as I did. So there's a lot of sort of earnings updates and things I would like to get around to, but those videos tend to take the longest. And I know one or two people have already asked for some of those videos. So again, I'll try and get to those first before we take any more requests on stock videos. So that's everything from me, though. Thank you very much for your attention. I'll try not to keep you waiting for 2.5 months till the next video. But for now, thank you very much, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.